Hi everybody. In anticipation of your exam being due next week, I thought I would review some adjusting entries with you. And so let's talk first about just why we even need adjusting entries. We need them because we are using an accrual basis of accounting. If we didn't recognize revenue when we earned it, and if we didn't recognize the associated expenses, so when those related goods and services that result in the expenses are used up, we would we would be on the cash basis of accounting, and these adjusting entries wouldn't be needed. So that's why we need them, and that's why they're important. So let's go ahead and go through problem 4.7a. And so in this particular problem, we have a small recording studio in St. Louis. New clients have to pay in advance for studio services. Bands with established credit are billed for studio services, so that means that they let their clients use credit as long as it looks like they're dependable customers. And so the recording studio does adjusting entries on a monthly basis, and so it looks like we need to perform December's adjusting entries. So hopefully you're following along in your book and you can see the transactions related to this particular problem. So let's talk about the first one. And it says that records show that $4,400 in studio revenue had not yet been billed or recorded as of December 31st. So we need to record that revenue, because again, we record revenue when it's earned. So on December 31st, we're going to have an adjusting entry. Now we've earned this revenue from our clients because we provided those studio services to them. Even though we haven't billed those clients, we have allowed them to do their recording, and so therefore we can recognize that revenue. So the amount was for $4,400. And we're going to go ahead and recognize that revenue. And we're going to recognize it in our studio revenue earned account. Okay, so there's our adjusting entry for $4,400 for transaction 1 that records that previously unrecorded, unbilled revenue. So let's look at transaction number 2. Studio supplies on hand at December 31st amounted to $6,900. So what we need to do is, since we know what's on hand at the end of the period, we know what would have been on hand at the beginning of the period by looking at our adjusted trial balance. And so let's go back up. And we see that studio supplies were at $7,600. So we know that we have $6,900 on hand. So what that means is our initial balance of $7,600 minus our ending balance of $6,900 means that we used up $700 worth of supplies. So let's do our adjusting entry. So since we used those supplies up, we're going to record that in supplies expense. So now we know that those supplies are gone out of our inventory by crediting our supplies account. So now we have $6,900 left out of our beginning balance of $7,600. So let's look at the third transaction. On August 1st, 2015, the studio purchased a 6-month insurance policy for $1,500. The entire premium was initially debited to unexpired insurance. Alright, so what that means is we have prepaid for some insurance for a total of $1,500. and that was for a 6-month policy. So we're going to divide by 6 because that's going to give us a per month amount for our insurance. So now we know that essentially we're paying $250 per month for our insurance. So let's go ahead and do the adjusting entry for that. So on December 31st, we're going to show that we have used up a month's worth of that insurance by expensing it. Okay, and now we need to show that we no longer have that amount, unexpired insurance in our asset account by the same amount. Okay, so now instead of, since we purchased the insurance policy in August, we've used up August, September, October, November, and December. So we have one more month left. So we should have about $250 left in that account. So let's do the adjusting entry for number 4. The studio is located in a rented building. On November 1st, 2015, the studio paid $6,000 rent in advance for November, December, and January. The entire amount was debited to prepaid studio rent. So again, we're going to have some prepaid assets here in the form of prepaid rent. And so we're going to take the entire amount that we paid in advance, so $6,000. And we're going to divide it for the number of months that we were prepaying, which was 3. So that tells us that our rent expense is going to be $2,000 per month. Okay. So let's go ahead and do our adjusting entry. So on December 31st, we're going to show that we incurred 1 month's worth of studio rent expense. Because remember, all we care about is December here. And we need to show that we no longer have that $2,000 in our prepaid rent expense, or prepaid rent account, I should say. Okay, so there's that adjusting entry. So let's move on to number 5, and we have some depreciation to record. So the useful life of the studio's recording equipment is estimated to be 5 years or 60 months. The straight line method of depreciation is used. So what we need to do is go see what our initial equipment expenditure was. So looking at the unadjusted trial balance, we can see that we had $90,000 in recording equipment. So using the straight line depreciation method, we're going to take the total value, historical value of that equipment, so $90,000, and divide it by, since we want a monthly expense, the estimated useful life in terms of months. And that's going to give us our depreciation expense per month. So let's do our adjusting entry. So we have to show that depreciation expense. And the other account we're going to use, remember, is our contra asset account called accumulated depreciation. So remember, accumulated depreciation acts to devalue the associated asset. And so therefore, that equipment, if we were to measure the book value, would be $1,500 less at the end of December than it was at the end of November. So let's move to transaction 6. On May 1st, 2015, the studio borrowed $16,000 by signing a 12-month 9% note payable. The entire $16,000 plus the interest, full 12 months interest, is due on April 30th, 2016. So we have a few calculations to do for this one as well. So our magic formula for interest, and if you are a business major, business minor, accounting major, go ahead and memorize this formula because you'll see it forever and ever and ever. Interest always equals principal times rate times time. And we assume that we calculate our interest on an annual basis. So here, to record our interest, we know we had a $16,000 note. The rate was 9%, so 0.09, times the time will be 1 over 12 because we're only recording 1 month's worth of interest. So we know that for December, we need to recognize $120 in interest expense. So let's do our adjusting entry. So we have our interest expense recognized. And now we need to do our interest payable because we no longer owe this interest because we're showing that we're going to pay it. So it's no longer payable. All right, so we're almost done. Have a few more. So number 7 is records show that $3,600 of cash receipts originally recorded as unearned studio revenue had been earned as of December 31st. So it looks like the studio is going to be able to recognize some cash here. So let's go ahead and record that. So now the studio gets to move that revenue out of unearned studio revenue and $3,600, and now they get to move that into their earned studio revenue account. So that revenue is no longer a liability because it's been earned, and so it is now income. So let's look at number 8. Salaries earned by recording technicians that remain unpaid at December 31st amount to $540. So it looks like we have the studio has some salaries they need to record. So let's do the adjusting entry. Now, even though we haven't paid them, we still have to recognize that that's an expense that we will have to pay in the future. So we're going to record the expense. But we haven't actually paid them yet. So therefore they go into a payable account. Okay. So number 9, our final transaction, is the studio's accountant estimates that income tax expense for the entire year ended December 31st, 2015 is $19,600. So the studio had already recorded $17,900. So that means for the entire year, they were going to have to recognize $19,600. they've already paid $17,900. So that means in December, they still have $1,700 that they need to take care of. So let's make that adjusting entry. So income tax expense for $1,700, and they still pay, and they're still payable. They haven't paid those income taxes yet. So therefore, we're recording them in a payable account. Okay, so hopefully this clarified some adjusting entries for you, and if you have any other questions, please give me shoot me an email or give me a call. Talk to you later. Bye.